Welcome to Bloomberg ETF IQ. I'm Katie Greifeld. Scarlet Fu is off today, and she's missing a great show. Let's get to the biggest stories right now in the more than $17 trillion global ETF industry. We start with the stock rally that was jump-started by Fed Chair Jerome Powell in Jackson Hole, losing a bit of steam on this Monday as we close out the last week of summer. Meanwhile, rapid growth in active ETFs, even as outperformance fades in 2025. We'll speak about it in just a moment with Matt Camuso of BNY Investments about that group. And we'll also speak to Greg King. He is the CEO of Rex Financial about his newly launched ETF, the first fund with spot Solana in the U.S. All that and more coming up. But as always, Eric Balchunas from Bloomberg Intelligence, he's here with us now. He's looking at the flows. Eric, what do you got?
Katie, I thought since it's basically the end of the third quarter, right? We're at the end of August here. Let's take a stock of what's happened this year in flow. So this is year to date we're looking at. VU at the top. This is reflecting a lot of what's happened in the past month too. It's been a lot of Vanguard, Beta, and some treasuries, and a little bit of Bitcoin and Ether. SGov here is treasuries, so people have been sort of buying the market, but they've also been hedging a little with some cash or gold. And then you've got IBIT here, which, again, another amazing year for the Bitcoin ETF. Ether actually is rising up the ranks here. It's 13th currently, so we'll see if that can make it up here. IVV in the queue. So I'd say this leans very bullish, and the total flows this year are $750 billion. So ETFs with 1 quarter left are scheduled to hit over $1 trillion for the second year in a row. Let's look at the outflows, and there is some money being taken off the table here from SPY. Although, remember, SPLG is like the cheaper version of SPY, so some of that's going from there to there. IWM, small caps. It just seems fundamental, the problem small caps have. People try to make them catch a break. They don't, and the outflows come out. We'll see if that can ever happen. XLE, energy. And here's some bond ETFs here, too. So some people coming out of bonds. But generally, again, net flows into U.S. equities. Let's look at why we've seen such a resilient market this year. The headlines have been absolutely negative. Economists, columnists, I've been talking about this for months. They're just very bearish. However, ETF investors are just not buying it. They keep buying the dips, as a matter of fact. So here's a look at all of the flows into ETFs after there's like a little bit of a pullback in the S&P 500. And you can see ETF people are generally dip buyers, but this year, it's like buying the dip on steroids. So the flows, Katie, aren't just the Vanguardian crowd. It's also the traders who are just loving every single dip they have, and that's why the market is so resilient.
Eric, thank you. Dunking on the columnist. Let's broaden out this conversation now with Matt Camuso. He is head of ETF solutions over at BNY Investments. Great to have you on set with us. Let's talk about what's been really popular this year. Of course, it's buying the dip, but increasingly, it's active management, it's active funds that are really having an audience with investors right now. I want to get your perspective on what type of active, though, because when you look at the ecosystem as a whole, we're talking about very different things here.
We are. And if you just look year to date, it's actually interesting to see. You mentioned, Eric, kind of the equity flows increasing for buying the dip. But if you actually double click into active ETF flows through July, taxable bond ETFs have shown a real surge. And this is kind of a continuation of a trend from last year. We're also seeing demand for just broad U.S. equity, but still that kind of non-traditional equity catching a bid, 45 billion roughly through July. Which is just continuing to see demand from even a handful of years ago. And we're also seeing the product come. So over 110 ETFs coming just to that non-traditional equity category, but 450 plus new active ETFs just this year. Again, a continuation of a trend of, seeing flows, but then meeting with demand with product from asset managers.
What does non-traditional equity mean?
So these are typically your kind of derivative income or outcome-based ETFs. Again, the first few came a handful of years ago and saw a nice kind of trade in the portfolio, if you will, high relative level of income, a low beta. But since we saw that spike in flows, now we've seen the product. If you look at this one category, Katie, over 550 active ETFs in one category. So the market itself for active ETFs is crowded, but this one in particular, the most crowded because we're seeing so much interest, and it's kind of a newer type strategy for the ETF industry.
Yeah, you bring up a good point. So we have active taking in 40% of the flows this year, which is a record. It's finally the year of active.
Finally.
Last year was good too.
Yeah.
And 90% of the launches are active, that's astounding to me. But a lot of this is not your grandfather's stock picking active. but let's talk about that active.
Yeah.
Why stock picking? Why shouldn't I just buy the index? Bond managers seem to do better, but stock pickers still lag when you look at the SPIVA reports and whatnot.
Sure.
How do you get people into active after those kind of reports?
Well, you mentioned the SPIVA report, and that's actually where we start the conversation with clients, is on data. So an interesting conversation we've had, especially if you're traditional ETF users that have been here for decades, right? They're traditionally passive. When you have the conversation around data for the large cap value category, if you actually looked at roughly 20 years of data on a 3-year excess rolling return standpoint, you're seeing a strong uptrend in outperformance. And it's not just for the best managers in the category, it's for even your medium or lower category managers, which shows us there's a higher probability for active to add that excess return. We have an ETF in this category, BKDV. It's our dynamic value ETF. But again, if you look at data, we kind of have that conversation. Where's the higher probability for stock pickers to really kind of earn their weight? But for that weight, where do you want to use your fee budget? Again, when you have that higher probability for outperformance, we think an opportunity just broadly to use that fee budget and choose active over passive.
I agree. The fee budget is important, and the more active share you have, the more you can charge, and vice versa. And I'm looking at this dynamic value, and the word value is in it.
Mm-hmm. That's a good word.
Yeah, value can't ever catch a break. It's been years. It's like small caps. What is up with small caps and value? Why can't they ever really get going more than, say, a couple months?
Yeah. And if you actually look at the reasons we think there's a higher probability for excess return in the value category, it's because of a factor kind of phenomenon. They just tend to be less sensitive to momentum and beta. However, if you look at just the opportunity for diversification, we still think it's an important piece of an overall portfolio, especially for those clients we're talking to, which tend to be financial advisors. They're not trying to have a good month or a good quarter or just a good year. This is for a long-term financial goal for their clients, and we need that diversification. So, you always need it sometimes when you don't have it, but just because they're less sensitive to that momentum, and beta factor, you kind of have that sometimes view, Eric, that you mentioned. They can only have it for a couple months, and then it kind of goes away.
Just got to zoom out the chart, you got to zoom out the timeline. I want to go back to non-traditional equity. Stuck on that phrase. It's interesting, you talk about what demand that we're seeing there. It seems like that's what investors are really interested in right now. And then I take a look at your equity ETF lineup. It seems very traditional equity. So is that a space that you're looking at as potentially white space for BNY?
So we are looking at the category, but I will say, and you bring up a good point, if you look at ours, it's a bit more traditional. We don't follow trends in terms of how we bring product out. We want to find where our best investment capabilities are that make the most sense for the ETF wrapper to bring those to add choice to the overall ETF industry. So we're not trying to catch trends. However, you can use that trend. This is, again, a newer type strategy that we're seeing broadly, not just for ETFs. This kind of idea of adding derivatives into an underlying to increase income. So we've actually filed for an ETF in this space. It's going to be an enhanced dividend type, taking an older, traditional, more income-oriented portfolio and actually putting in a derivative underlying to increase that income. So it's not exactly for the category, but if you just look at our kind of product development roadmap broadly, we're not trying to chase trends. We're trying to see where do our investment capabilities best fit for ETF investors.
So, Katie, we talk on the show that you can basically get everything for free now.
Yeah,
but,
it's great.
That term is used loosely. Normally we mean 3 basis points, 4 basis points, but these guys, it's literally free. You have a large cap at 0.00 fee.
Correct.
And an aggregate bond at 0.00. So you have the whole 60-40 for no fee.
Correct.
Now, they do have $5 billion between them. That's not bad. But, the Vanguard and BlackRocks are hauling in that every other week. So how come this doesn't catch on more? How do you sell it? Is the brand that big of, is it just the brand name that people like? Or at some point, do people not want free? They actually want to pay a little.
I don't think they want to pay a little, but for a long time, the conversation in the industry was the race to zero. We like to say we won. Right? We're the first year for true zero fees. I think, and we get the question a lot, why haven't they grown more? The ETF industry is extremely competitive. There's a lot of product choice, but I think there's also a fundamental misunderstanding for ETFs baked in here. It's the larger the AUM, the safer the ETF is. It's just not the case. Right? ETFs are open-ended vehicles. We can create more shares. We all know the story that AUM or ADV of a ETF really doesn't judge the underlying liquidity. I don't think the industry is there yet. We also have the problem that people have owned these other ETFs in the category for a very long time. So there's a tax burden to get away from those and maybe save 3 basis points. They are, though, continuing to grow, and we're excited about the prospects for them going forward.
Matt, I have to ask the obvious question. How do you make money on a fund that doesn't cost anything? Do you just accept that these are going to be loss leaders?
We do, and I think this is a great example of the scale of BNY. If you look across our enterprise, not just our ETF issuer, we have business lines that touch every part of the ETF ecosystem. So we're able to bring this scale for cost saving to our client. And Eric, you mentioned the entire 60-40 for free. We were intentional about what products we chose. These tend to be the largest allocations in a portfolio. If we're going to pass along fee savings, we want those to be an actual meaningful allocation to the overall fee budget.
All right, Matt, really interesting conversation. Great to have some time with you. That is Matt Camuso of BNY Investments. And coming up, ESG investing goes on the defense. We'll discuss why the funds are leaning more into nuclear weapons. I know that Eric is psyched for this conversation. That's up next. This is ETF IQ. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with another way to look at just how big the ETF industry has grown, and that is the fact that there's now more ETFs than there are individual stocks. We were talking about this a little while ago, a few weeks ago, and it's really neatly illustrated in this chart. You can see the number of ETFs in purple, just a steady climb there, whereas the number of U.S. listed companies has actually been middling a little bit. So, of course, the flipping has happened, though Eric Balchunas has pointed out to me there's also more mutual funds than stocks, so who knows? Let's talk about something else. And specifically, we're going to talk about the Capital Group Municipal High Income ETF total assets. This was likely the result of a model portfolio tweak, because if you take a look at that long, skinny bar, that would be the biggest one-day inflow ever for this ETF, taking in over $1.5 billion in a single day. So interesting movements there. But let's get to the good stuff. Let's talk about ESG equity funds. They're going really big, actually, on nuclear weapons. Nuclear weapons are now ESG, according to at least some funds classifications. You can see that in yellow, funds that promote ESG have really been increasing their investments. And let's talk about this issue a little bit more with Shaheen Contractor. She is Senior ESG Analyst of Bloomberg Intelligence. This was a request from Eric that we do this. So, if he has some stuff to say about ESG, it's not me. But just talk us through this, what the logic of this is.
So, Katie, basically what we found is that ESG funds could see increased allocations to nuclear weapons, and that's really driven by this EU rule clarification that now explicitly excludes nuclear from the definition of controversial weapons. So it's always controversial weapons that's been, for lack of a better word, controversial. Given this exclusion, ESG funds could see increased allocations.
The reason this gets me going is because we tried to warn people that this is so subjective.
Yes.
And these index makers are trying to put make something subjective objective. If you open the hood of any ESG ETF, I guarantee you'd be surprised what's in there, both good and bad. This is probably the ultimate, like nuclear weapons, like nobody would think that's ESG. But the problem is the European government wants money in defense companies because they're got Russia invading the Ukraine. So, but all the private capital is like, you told us not to do this because it's not ESG. They're like, wait a second. This is the problem with getting moral with your money. I think you end up it's gonna bite you. And the other problem is, let's say you allow this. What about the fossil fuels needed to power the weapons? Is that now ESG kosher too?
So Eric, I love your comparisons between fossil fuels and I guess nuclear weapons. What I would say is, you hit the nail on the head with these value screens being, first of all, debatable, ever-changing, and subjective. The comparison I would make when it comes to ESG and maybe fossil fuels is the driver there is really more financial. Like if you just think fossil fuels, if you think climate change, the real aspect there is as renewables increase, oil could get more as a stranded asset, and that's a financial thing. But to your point, nuclear weapons as a values-based thing, subjective. So that's the line I would draw: financial materiality versus values-based.
Agreed. And what do you think of this? ESG should just be like, we're trying to outperform and we're picking stocks in a way we think will. To me, that's all that needs to be said.
That is what ESG is.
Once you start saying we're going to be good, that's where it gets weird.
I agree. So that's where we have the socially responsible investing umbrella, and you have values-based versus ESG. I think our view is always that we look at financially material metrics and those that outperform. The values-based is historically, I guess, traditionally what's been looked at and continues.
All right, Shaheen, got to leave it there. Always a really fascinating conversation. That is Shaheen, Contractor of Bloomberg Intelligence. And of course, you can read the story that we're talking about on Bloomberg.com or on the Bloomberg terminal. It is the subject of today's Big Take. Now, still ahead, we drill down into crypto ETFs and Solana with Greg King. He is the CEO of Rex Financial. Next, this is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Katie Greifeld. It's time for today's drill down where we focus on one ETF. Eric, hit it.
Katie, today we have an interesting product here, SSK, which is the Rex Osprey Sol and Staking ETF. First spot Solana ETF, although it's under the 40 Act. There's a couple, I won't get into the wonkiness, but there's a bunch of 33 Act spot ETFs waiting to be approved, probably in October, but this one got through in the 40 Act. And you can see here it's got 182 million since it started. It's 75 basis points and basically holds spot. I'll show you how. Let's look at the holdings here. How does this get exposure to Solana? And you can see here it's going to hold the 21 shares staking Solana ETF in Canada. And then it's also going to hold, in Switzerland rather, and it's going to hold spot. So again, one ETF, one spot, and it is staked, which is important because you get a little yield from that. Let's just look to see how it's performed versus the Solana Futures ETF, which has been out for a while, and Solana itself. And you can see that it is underperforming these. We're going to ask Greg what's behind that. But the bottom line is it is up 23% in only a month and a half. Right? That's a 341% annual equivalent, Katie. That's why it has 180 million so early.
Eric, thank you. And joining us to talk about this ETF is Greg King. He is the CEO of Rex Financial. Greg, great to have you with us. For the non-crypto natives that are watching right now, just briefly, what is staking and how are these rewards actually distributed and taxed, for example?
I could probably spend an hour answering that question, but staking is a different mechanism for securing a crypto network. People have probably heard of Bitcoin and how the mining of Bitcoin requires huge amounts of energy, electricity, and so on. So somebody came up with the concept to stake coins, and what it really means is instead of devoting all of that energy to mining, you can just rely on people who hold large portions of the crypto in question to stake that in exchange for those rewards for securing the system. And so it boils down to, for investors, basically an interest rate on your crypto. And for Solana, it varies. It's somewhere in the 6 to 8% annualized range. So SSK is the first fund basically to deliver that staking reward through to investors in the U.S.
So, Greg, when you talk about stablecoins and tokenization, a lot of people say it's all going to happen on Ether. Solana is one of the hotter coins. It's rising up. What's the case? What's something a regular person can understand that it will benefit from?
Yeah, so ETH is obviously the second biggest crypto. Solana is basically top 5. And a lot of people think that Solana is the up-and-comer that's going to sort of dethrone Ethereum. It's a very controversial debate. I probably made friends and enemies by even suggesting that just now. But Solana is basically faster and more designed for high processing speed. And so, frankly, when I saw the big debate come out about stablecoins being all built on ETH, I was like, this is a huge oversight. I think Solana is actually the story for the future as far as stablecoins go.
Interesting. And when it comes to Solana and how that ecosystem is represented in ETF, so you have Solana Futures ETF, you have what your ETF does. When are we going to see pure spot Solana ETFs come to market?
Well, as you know, as you said earlier, there's a bunch of filers waiting for the SEC to approve what are called 33 Act Solana ETFs. What's interesting is the whole crypto ETF ecosystem has sort of been built out using the 33 Act structure. And for those who don't follow this so closely, that's basically a commodities-centric ETF structure. The 40 Act structure is more for securities, and it is the better wrapper, in my opinion. It's got more investor safeguards. It's more flexible. And so SSK was the first 40 Act crypto fund to come out in the United States. We had to jump through a few hoops to get there. But the majority of the fund holds spot Solana and stakes it. We hold some other ETPs as well, and then we distribute out a monthly return on that, roughly 5% a year right now.
And so in October, we're expecting a bunch of the spot 33 Act coins to come out that have futures on them. That's the criteria the SEC is using. So that would be like maybe 6 or 7 of the other big coins. But then there's 40 Act filings that would track, even some meme coins. Do you think we're going to see like an explosion of coins even beyond the sort of 6 major altcoins? How crazy could this get in the next couple months?
I don't know about the next couple of months. I do think we'll see somewhat of an explosion. I mean, where else in ETF land did you have, 6, 8, 10, 12 people lining up to launch the same exact thing over and over, right? Like we've seen with a Bitcoin ETF and then with ETH, now with Solana. I don't know how many filers there are, good, 6 or 8. And so those numbers just multiply, and I think you will continue to see that. That being said, crypto gets pretty sketchy below the top 10, certainly below the top 20. And so I think there's, some significant picking and choosing that has to happen by issuers there. I wouldn't imagine just a huge explosion. I do think there will be a lot of funds per coin, and certainly Solana as being one of the top 5 is a great candidate for that. It's not only one of the top 5, it's sort of the underdog and the up-and-comer in terms of dethroning Ethereum, and it has a much larger interest rate, staking reward to it. So that's why we think it's pretty interesting as a portfolio investment.
All right, Greg, that's probably a good place to leave it. Really appreciate your time today. That is Greg King. He is the CEO of Rex Financial. And you can read all about this drill down, plus the latest in the ETF industry, when you subscribe to my weekly ETF IQ newsletter. That is Bloomberg.com/ETF IQ newsletter. And a quick programming note, because of the Labor Day holiday, we'll be back on Wednesday, September 3rd at noon. That does it for Bloomberg ETF IQ, the TV show. I'm Katie Greifeld, along with Eric Balchunas, and this is Bloomberg.